So that brings us to markets and investing. So when we're looking at the speed dials again from a credit standpoint, I've said this quite frequently. Not a whole lot of movement there. It's in good shape. It's all green, so we're not going to spend a whole lot of time there. But I do want to talk a little bit about the default rates that are coming into play right now. So when we're looking at this chart, this shows a graph of non-investment grade defaults and the rates over time. And you can see in the financial crisis of 2008, 2009, that there was a 15% non-investment grade default rate, which was rather high, quite frankly. But that kind of went back down in 2010, and you always have this jostling going on within a chart like this when you're talking about defaults. But ultimately, when we got to this crisis, what we're projecting, because this is more of a lagger as far as what we're projecting here as far as the defaults go, we're projecting about a 12% default rate. Right now, we're at about a 6% default rate. And again, this is investment grade, non-investment grade default rates. So is that a very high number? Well, it's high, but it's not anything that our institutional money managers don't believe they can handle or weather through. Now, why is that? Well, because they're rather selective as to who they're bringing into the portfolio. So they are looking at the cream of the crop when they put these portfolios together. So they're projecting that the default rate within the portfolios would be much lower than the overall default rate. So that's a good thing for anybody out there wondering about that aspect of the investing. So let's move on to the equities market. Again, the fear indicators red, valuations are red. Overall financial conditions are moving forward, so that's good. We've looked at this chart many times, and ultimately the chart shows the price earnings ratio for the S&P 500, and this chart is still on the high side. We're sitting at 21.41 right now on the price earnings ratio of the S&P 500. So even with the bit of a dip we had, the number hasn't changed that much because the earnings just are not kicking in at this time. So that's an area, again, we'd like to see the numbers get down into the blue area, somewhere between 15, 14, 16, somewhere in that area, to put us in a much better position where the institutional money managers are ready to dip in. And by the way, that would be a good time for us to be able to jump in and start implementing our strategies. So this is something we're obviously working or looking at. So we'll just keep watching it as we move forward. So that takes us to where we are now. And you're looking at this chart, and what we're seeing here is a market that is starting to capitulate a little bit. They are showing a little bit of weakness at this point, and it's something that we're looking at. So when you're thinking about the COVID crisis, and you start seeing the fact that the news is really kind of portraying things in a less than good light, what you're finding is that the market's getting a little weak because of that. Now, as we were talking about last week, if we have that in combination with bad earnings, it could very well be the catalyst that moves us down the slide here and puts us in a position to actually start executing. We are looking for, and many of the institutional money managers are looking for, what they call a healthy correction at this point, which would be anywhere from 10 to 15%, really up to 20%, but they're looking right now at about 10 to 15% correction, and that would actually put us in a position whereby it would get us in that blue zone where if we execute, the execution mark would be somewhere between 2,500 and 2,700 on the S&P 500. So we are watching that and we are anticipating. So we're ready to execute if we do hit those numbers. When you think about earnings, so there's good news and bad news with earnings out there. There is a significant drop expected for 2020. So effectively about 20% drop in the earnings on the S&P 500 as a whole. Again, big drop for 2020, but the silver lining is as we ramp back up again, we're looking at 2021 having about a 27% increase, which would put us slightly above where we were at 2019 levels. And I think they tend to be a little bit conservative on these numbers, but you know, we've got to wait and see how it actually plays out. But I would imagine that again in 2021, it's going to be a good year for us overall in the market. If you think about where the earnings took its biggest toll, U.S. small cap stocks were the ones that got hit the hardest from an earnings standpoint. So their earnings dropped about 39%. Then you kind of go over to emerging markets in excluding Asia, that's about 24%. The two best would be emerging markets, Asia and U.S. large cap being the healthiest of the sick, I guess if you would put it that way. But we'll be watching that. We expected it to come in this direction. We'll kind of see how it actually plays out in next earnings season, which is right around the corner, which should really give us another chart like this to give us an update. And as you get closer to the recovery in this data that we need, you'll see the numbers kind of get very more targeted as to what we're estimating will transpire as we move forward. So again, watching the data. So all in all, you know, the markets are really moving forward. The economy is moving forward. So there's a lot of positive things going on out there. Certainly, we do have to get everybody back to work. You know, I've talked to a lot of business owners. Many of them say, well, you know what, you know, we're trying to get everybody back to work, but they're sitting home collecting that check. So they're kind of refusing coming in yet. The checks will stop. And I'm pretty sure those people waiting at home will probably change their tune at that point, which could get us a relatively big influx on the workers coming back to work. So a lot of positive things there.